Hello, I'm Ted Seides, and this is Investment Management Operations. This show explores the inner workings of the most sophisticated institutions in the industry. Through conversations with executives across operations, compliance, legal, and finance, you'll hear how key operating partners run their businesses in an ever-changing and complex investment landscape. You can join our mailing list and access Capital Allocators content at capitalallocators.com.
I'm Scott McDonald, and I'm your host. My guest on today's show is Scott Farden. Scott is the COO of Nonantum Capital Partners, a Boston-based private equity firm that spun out of Charlesbank Capital Partners in 2018. Launching a first-time private equity fund has a myriad of challenges, from leaving your old firm, raising capital, finding talent, and activating operations, so I turned to Scott to share his experience. We also covered topics like proper preparation and common pitfalls when pitching LPs, building a team that can evolve with future organizational complexity, and things one can do to proactively build culture for firm durability. After our sit-down, Scott shared that he believes that operations can't add alpha to a PE portfolio by running it so well that it leaves the investment team out of the back office. And with that, please enjoy my conversation with Scott Farden. Scott, thanks for joining me today. I'd love to start with hearing how you got into the industry.
Sure. Be happy to walk through that. Very proud of where I grew up and how I got into the industry starts there. And when I think about where I came from, I grew up in a small town in northern Minnesota, an iron ore mining town of about 10,000 people on the Canadian border. It was a great place to grow up. I was the youngest of 7 kids. I was raised by a single mom. She grew up on a farm in North Dakota. She was one of 9 kids, and she was my hero. Growing up in that small town, I wasn't supposed to end up in New York City or in Boston working in private equity, but I was very fortunate. In a small town, a lot of people look out for you. I happened to be a decent student and a decent athlete, and that opened up a lot of opportunity for me. I got recruited to play hockey at Harvard and was fortunate to get admitted. Nobody from my town had gone to Harvard in 20 years. I didn't come from a professional family or a professional background. I arrived at Harvard. I studied economics. I played hockey, still involved with the hockey program as a mentor and as a board member. I had several jobs. I started my own student care package company. But going to Harvard was like a 4-year trip around the world for me. And it opened up a Disney World of opportunity in life. So I'm there. I'm a senior. I'm thinking about what I want to do with my life. I had no idea.
You won a national championship too?
We were fortunate to win a national championship. Yes, it was a great experience. I was so fortunate to be on a team of really good people and good hockey players. And the lessons learned from being in a locker room have filtered through my entire career and impact what we're doing here at Nonantum today. What I mean by that is, over the years, having had a few laps around the track, you think about leadership and what you learn in different organizations. And on teams, in winning a national championship, we just had great leadership on that team. And over the years, I would encapsulate that by saying bad teams have no leadership. Good teams are coach-led. Great teams are player-led. We were fortunate to have some great player leaders on our team. And the lessons I learned from my fellow teammates, I've carried with me to this day, and I'm really grateful for that opportunity. So winning was great, but the experiences that you get along the way are what are valuable. To really get on with answering your question, I was a senior in college. I paid my way through school. I had a lot of debt that I had to pay off. But my dream job was to become a general manager of a professional sports team. So I started pursuing roles in professional sports. Back then, 1989, you really had to know somebody. You had to have a family member that owned a team to get a job. Well, I was fortunate to get an offer to go work for the Minnesota Timberwolves. They were preparing to launch. I was really excited about it. And then I looked at the salary they offered me, and I wasn't going to be able to pay rent, let alone buy food, let alone pay off student loans, et cetera. So I said, all right, I got to go a different path for now. And the best and brightest seemed to be looking at investment banking, management consulting. I pursued both, ended up taking a job in investment banking and moving to New York City. So for a little small town iron ore kid from Minnesota, I land in New York City. I learned a lot. in investment banking in my first 3 years out of school. I learned a lot about capital markets, got a broad-based exposure to the business world, learned how to work hard and under a lot of pressure. And all those things were really great. But I also realized early on I didn't want to be a career banker. I was more attracted to the money management side of the business. I had an opportunity to try my hand at equity research, which was a much better fit than banking for me. I love digging into a problem. I did that for a couple of years and really enjoyed that as well. I had some good mentors who taught me how to do research and how to be a detective to solve problems. And then at the time, I had a great mentor who was at Goldman Sachs at the time. He was starting up an asset management business and he wanted some sort of general management talent to help get the business going. So he offered me a role in what we now call distribution and sales. It was product creation, sales, et cetera. And he hired 10 of us to take on this role. So I switched careers and I got out of the manufacturing plant, if you will, and I went into the distribution facility. Let's figure out how to create a product and then go find assets for it. This mentor was great for me. He's still alive to this day, and I still talk to him quite regularly. But he saw something in me early on, and he thought I had the skill set to become a CEO someday. And I hadn't thought of that. I was a kid. But at the time, the pathway to becoming a CEO of an asset management firm was become a rock star portfolio manager, do that for 25 years, get bored and burnt out, and then become the CEO, not having gained any skills along the way to actually run a business. But it was starting to change. He described the industry to me as a three-legged stool. Every asset management firm has three legs. One is the manufacturing plant where you're picking the stocks, the bonds, making the investments. Two is the distribution facility, sales, marketing, investor relations, all of that. And three is infrastructure and operations. And he said to me, two of those three are revenue generators and one is a cost center. If you want to get to the top, you should pick one that's a revenue generation thing. So here I am 35 years later running operations for a private equity firm. My views have changed on that a little bit over time.
I want to go back to understanding the difference between working in investment banking versus research. What was the takeaway for you to say, this isn't for me, and why you decided to go into the equity research?
Investment banking was a great place to learn. I had a liberal arts background from college. I didn't know how to balance a checkbook, let alone run an LBO model or anything like that. So I wanted to get technical experience and I wanted to learn how to read an income statement and tear apart a balance sheet. And so I got that from investment banking, which was great. I also got broad-based business exposure, which was great. It was very transactional. And I liked that versus management consulting at the time, which was my other opportunity. I wanted to actually get stuff done and transact. With banking, once I got some technical grounding, got a few deals done, and learned a few things, the more creative, artistic side of me said, I'd like to do less transactional stuff, and I'd like to go do some research and be able to make investment decisions based on my own views. And I thought I had a little more control over what I was doing. It seemed a little more creative, which were juices that I didn't know that I had, but they started flowing a little bit. And when I was working in banking and you're transacting on deals, you got to interface with the people on the research side. Their job just looked a lot cooler to me. They got to do a lot of research and then they got to write about it. And I liked to write. So I moved on to that side of the business. That was fun and interesting to me as well. But it then turned out that that wasn't my best use of my skills either.
How long were you at Goldman?
I was there for 6 years.
Where did you go after that?
I went to Morgan Stanley. I started in New York right out of college. And then I went to LA for about 6 years and then was recruited by Morgan Stanley. And I came back to New York. By that point, I was 29. My wife and I had just gotten married. We hadn't started a family yet. And at the time, on the institutional asset management side, Goldman's business was new. It was probably a C if you were giving grades out in asset management, and Morgan Stanley's was an A. I got recruited by Morgan Stanley to come back to New York. So I did that. And that was a great decision at the time. 10 years later, I think Goldman's asset management business was an A and Morgan Stanley's was struggling a little bit, but such is life early in your career. Early in my career, I spent time at Goldman and then Morgan Stanley. But I ended up after 9/11, all of a sudden I wake up one day, I've had 5 good years at Morgan Stanley, really enjoyed being in New York. All of a sudden, my wife and I have two little babies. We're living in Connecticut. I'm doing a hour and 45-minute commute into the city every day on the train. 9/11 happens, and I would put my kids to bed on a Sunday night. I wouldn't see them awake again till the following Saturday morning. And one morning, I'm standing on that train platform in Connecticut, and I just said, I'm not going to do this for the next 25 years. We need to get near one of our families. And so my wife's family's from Boston, and we decided to move up to Boston at that time. And it was a great decision. Two little babies, moved up to Boston. I got recruited to come up and work at State Street Research. State Street Research no longer exists, but at the time it was a $50 billion long-only money management firm. At that time, I still thought I wanted to be a CEO someday. And so I got recruited to run their global distribution function, which I guess in today's world, people call you CEO of capital formation or some fancy title that they've given. And that's essentially what it was. But I was 35 years old. I was on the management committee, one of 5 people, and I was on the pathway to running a big asset management firm. And we were owned by a big insurance company. 3 years after I joined, it was a turnaround play, and we got it turned around and we got it headed in the right direction. And the insurance company decided to sell the business to BlackRock. This was when Larry Fink and company had just started their acquisition spree, and we were one of the first with 50 plus billion in assets. We had 19 partners at the firm. None of us stayed at BlackRock at the time because our roles were all redundant. But that was a point in my career where I had a little bit of an epiphany. With the young babies at home, getting to know myself a little bit better, I realized that the job of being a CEO or being someone who's in line for that, it's not really a job, it's a lifestyle. And it was a 24/7, 365 thing. And I realized that didn't fit me and it was going to burn me out. And so my career epiphany was really, I'd like to go do something small, get back into a locker room feeling. I ended up joining a startup hedge fund in 2004. And in 2004, the hedge fund business was booming. There was a group that had just spun out of Harvard Management Company, and they were starting a multi-strategy fund. And I came on board to raise assets, help run the business, et cetera. And that was a big career turning point for me to go from big to small and get off the CEO track. And it was the best decision I had ever made in my career. I wanted to coach, Scott. I wanted to be able to leave the office at 3:00 and go to the hockey rink and coach my kids and coach soccer and be around for quantity time, not just quality time. What I learned about myself too at the time was I'm a way better number 2 than I am a number 1 because I can go to bed at night and have a lot less to worry about. But I prefer to sit in the background and listen rather than be the person that's out front. And I don't think you can really learn that until you're there a little bit.
Totally agree. I think that self-awareness is something that people tend to overlook or not think deeply about that. Was there a moment when you just realized that I'm in a much better spot as a number 2?
Yes. I was at that stage in my career where I had a chat with my mentor. My mentor said, your career is about having 3 stages. The first stage is to learn. The second stage is to earn. And the third stage is to serve. I stepped back from that and I thought, you're doing all 3 of them, hopefully, or along your entire career path. But I realized that the 24/7 nature of the job, I was learning and I was earning. I wasn't serving my family and I wasn't serving myself because it didn't make me happy. And what I learned was growing up without a father, having a single parent mom raise us all, I probably had a big fear of waking up one day, having adult kids and having my kids say, where the hell was my dad for the last 25 years? I realized for me, I couldn't do both the way I wanted to do them. And so going small, and then as you know, Scott, if you're on the distribution side, especially early in your career, you got to put up numbers. If you're putting up numbers, nobody cares where you are, what you're doing. If you're leaving at 3:00 to go coach your kid's soccer team, if you're ringing the bell and getting things done, you are afforded trust, which then affords more flexibility in your lifestyle. And I realized that that's what I needed to be happy.
So you were at that fund for how long?
It was until the great financial crisis.
Oh, you got experience there. We all did.
We did. We were off to a really good start. We were putting up good numbers. We raised capital. And then the great financial crisis happened. We took a big drawdown in the fund and we had to wind it down in 2009. And that was a hard experience. Prior to what I'm doing now, it was the most fun I'd ever had working by miles. I loved the people I was working with, great culture, values were really aligned, and I enjoyed that. And then when we had to shut that thing down, I said, okay, what do I want to do now? Do I want to go back to a big firm? Do I want to do another hedge fund because the business was still booming? I did. I went to Raptor, and Raptor was run by a famous long-short equity manager in Boston named Jim Pilata, one of the great equity managers in history. And he had been part of Tudor Investments for a long time, and he decided to spin out. So a small group of us joined him to help him spin out of Tudor and launch a multi-asset alternatives firm, at the core of which was going to be equity long-short. And we had a $7 billion long-short fund that we were going to launch with, and then we were going to build some other things off of that. Phenomenal opportunity to work with one of the all-time great investors, and he recruited an A-plus team to help build this business. He was at a stage of his career where I think he realized he didn't want to run long-short money anymore. He decided to turn his business into a family office, but all of the senior team that joined to run the business, that wasn't what we signed up for. So I left and decided to go get into private equity. And it was 2010 or 11. I had never been in private equity, decided to join Providence Equity, which was a really neat experience. And if you think back to our career arcs in the early days, where were the best business people and distribution people coming from? They were coming from the liquid long only firms, because you had to learn how to go to market launches with new products. You had to learn what LPs liked. You had to learn about where the demand was in the market and in portfolios for different types of products.
And you're always raising capital. So you're always building that network.
Always. The alternative space was still in its infancy at that time. And so Providence and then Blackstone was well ahead of the curve, but they started to look for people who'd come from the long only world that could institutionalize and professionalize their business models. So I joined Providence as the global head of distribution. And it was really sort of the office of the CEO. There's a general counsel, CFO, and then someone running distribution. And I got to Providence at a really neat time.
How big was it when you started?
When I started, they were on Fund 6, about to raise Fund 7. It was about $40 billion globally, 8 offices around the world. I had 23 people at the time just on my sales and marketing and IR team in Europe and in Asia, in the US, in the Middle East, et cetera. But the firm had its flagship product, and then it was starting to expand. It had started a credit business, which I got very involved in helping launch. And then we launched a small cap tech strategy as well. It was really fun. It was a lot of great people who had had tremendous success over a long period of time. But then, like a lot of firms in private partnerships, they all go through a generational transition at some point. And so after 5 years or so there, the founders were starting to retire and hand it over to the next generation. And those transitions can be challenging. They can be clunky. They can be a lot of different things. And Providence was going through that generational transition. And right at that time, I get a phone call from a really good college friend and a former hockey teammate named John Biotti. And John was one of the founders of Charlesbank Capital Partners in Boston. John was there from 1998 until 2018. He had a great run there, and Charlesbank itself was going through its own generational transition. And John was one of the founders. He was one of the early people there. And they decided at Charlesbank to supercharge the firm, start new products. So they started a tech product, they started a credit product, and they decided to take the flagship from the lower middle market to the upper end of the middle market and quintuple the fund size. And for John, he really likes the lower middle market. It was probably the friendliest spin out in private equity history that I'm aware of. He decided to spin out and start Nonantum. But while he was going through that thought process, he called me to bounce ideas off of him. We started talking, and over the course of maybe a year or so, and then he ultimately decided to do it. And he asked me to join at a time when Providence, my old firm, was going through its own generational transition. And I had a chance to get in on the ground floor as a founding partner of a private equity firm in Boston with someone that I knew for a long time, I trusted, I loved, and I really respected. It was a no-brainer for me to join John. And so we launched Nonantum in 2018.
So you have an opportunity to work with somebody who you know, you've been in the locker room, you've been on the ice together. But the question is, there are a lot of things that are out of your control that you don't know. What were the questions that were going through your mind for launching a new firm to mitigate the risk of starting and launching? What were the elements of that recipe that felt like, okay, we have a likelihood of success here to actually get this bird off the ground?
The first risk box to check in launching a private equity firm is anyone going to care? Meaning, are you going to be able to raise the assets? And we were in a very fortunate position in early 2018 when we decided to launch Nonantum, in that John had a 20-year track record at Charlesbank. The Charlesbank folks gave him full attribution to his track record, and it was a very good record. We were what I would describe as a mature, hard-to-access startup in 2018. We made 10 phone calls to potential LPs. And they all said, if you launch, I'll join. And so we felt very confident that we were going to be able to raise the money and raise it fairly quickly. What happened was Charlesbank gave John his full track record access. They gave him access to all the LPs. All the Charlesbank partners invested in our Fund 1 and Fund 2 and signaled to their own LPs that they were going to do that. We were highly confident that the fundraise process was going to be fairly short, and it was. We raised our first fund without making an outgoing phone call in about 45 days.
Wow.
That was really, for me, especially having been in the hedge fund space where I was part of a couple of meteoric rises and then spectacular falls, I thought, man, the 10-year locked up capital that you have in private equity will be a lot better for career stability. And Providence Equity taught me that effectively. And then when I knew that hitching myself to John, who had an amazing record and LPs just wanted to be with him, de-risked the situation tremendously.
Most organizations are not set up for success like that. Is there anything that John may have done differently that other people didn't?
I think what helped John a lot is he was a founder at Charlesbank. He had 20 years of a demonstrated record, but very importantly, he knew all the LPs. And the Charlesbank model, I think they had 2 people in an IR function, but the partners managed all of the investor relationships. So the LPs knew him and had gotten to know him over a 20-year period. What a lot of people that are starting private equity firms don't realize is that your brand equity in terms of LP relationships really matters. If you're just someone who doesn't have a track record and you haven't met any of the LPs, but you put together a really fancy deck and you hire a placement agent and you just start going out and doing meetings without really understanding how LPs think, how they behave, what they like, you will fail. A higher probability of failure because you didn't prepare properly to go out and launch. So John had a lot of things going for him and had a lot of wind at his back when we launched.
When you were going out, did you have a singular anchor investor that helped give you the green light?
We did not. Our first fund was about $400 million. We ended up with 27 institutional LPs in our first fund. And the largest happened to be the GP. So we were aligned. But outside of the GP, the largest investor was 30 million. And we had 27 in total. And it was very well diversified across a lot of investors. We were very fortunate in that a lot of Charlesbank investors wanted to follow us. And so 55% of our day one LPs for Fund 1 were Charlesbank legacy LPs, and 45% were new LPs. We wanted to send a message to the marketplace that we could stand on our own and not just rely 100% on a few anchors or all Charlesbank LPs. So friends of Charlesbank LPs who weren't Charlesbank LPs ended up filling up that 45% bucket. We were super fortunate at that time. But I do talk to a lot of first-time funds who don't have the luxury of having those legacy relationships.
When somebody calls and say, hey, Scott, how should I do this? I don't have the recipe that you guys have. What do you recommend saying? What's the minimum viable element to actually get that going to mitigate the risk of failure?
We've all heard the saying, you get one chance in life to make a first impression. People need to remember that, because what happens is so many people will go out to launch a new fund, and they're smart and they have experience, and they put together a deck, and maybe they hire a placement agent, and they fly around the world, and they have 300 first meetings, and then they get 4 second meetings. I get these calls frequently from people. Why aren't we getting more meetings? Well, it's because you didn't prepare properly. What do I mean by that? I like to pull a quote out of the Untouchables movie: never go to a gunfight with a knife. And I think a lot of new managers will go to gunfights with a knife. What do I mean by that on a more practical level? You can Google right now, what do I need to do to start a private equity firm? You'll get a playbook for hire counsel, hire this. These are all the basic playbook things you need. But what that Google search will not yield you is practical advice on how to show up for those first impressions and make it count. What we did early on, and what I counsel people to do, is create a deck, because everything flows from your deck. And then before you go do a live meeting with an LP, go to your trusted friends in the industry who are really smart, who are experienced, who've looked at a million decks, who've said no to a million GPs, and have them look at it and then implore them to give you honest feedback. And then refine and refine and refine, and go out and then test drive it again and again and again. Before you go have an actual live fire meeting, you need to really do that. I can't emphasize that enough. Folks that have called me over the years that are about to launch, I give them that speech. 9 out of 10 ignore it.
It's fascinating because you're almost better off talking to these people that are your friendlies that will turn you down. And so when you do go into these high stakes events, you're not swinging at the first pitch.
Exactly. I think that the key to all of that is take a page out of Ted Lasso. Be curious, not judgmental. If you don't understand your buyers and why they buy and what they buy and why they say yes and why they say no, you're going to make a bad first impression. You're going to walk out of every meeting thinking, I sounded really smart. Our product is really cool. And then you're not going to get a follow-up meeting, and you're not going to understand why. It's be curious, not judgmental.
Is that why a lot of people come out of a meeting and say, oh, that was a great meeting, and then the other person be like, that was a terrible meeting?
Yeah, I think that's exactly right. We've all heard this other cliche: if you're talking more than 50% of the time in a meeting, you're talking too much. LPs are really smart. They know a lot. They've seen thousands of you come through, and very few of us actually ask questions of them. But I've learned more from LPs in my career than anyone. And so if you ask questions and you truly care about what they're trying to do, what they're looking for, you learn a lot. And at the end of the day, when you have a mutual collaborative discussion, you build trust and you learn things about each other. And if you have something that nobody else has, you can go in and throw up on someone and still get an order. But our business has become so much more commoditized today than it was 20 years ago in private equity. You have to really have a strong value proposition, and you have to communicate it clearly, and you have to listen.
I'd love to give people an overview of where you are today. And I'd love just a snapshot, just in your roles and responsibilities within that, just a frame.
So Nonantum, we started with roughly a $400 million fund in 2018. We invested that. We raised our second fund at the end of 2021, and that was a $650 million fund. And we're about 70% invested in that fund. And later this year, we're going to raise our third fund. It's going to be slightly larger, 750, 800 million, something like that. We're keeping things small. If we take our current marks, we're managing about $2 billion in assets now through our second fund. And we started with 8 people. Today we have 25. We're growing nicely. When we started, we have a total outsourced model. What do I mean by that? We decided to outsource. The first thing we did, we have to get legal documents drawn up. So we hired counsel, and we went with a brand name. We hired Proskauer. We decided to outsource everything except for the investment function. And so in my role as the chief operating officer, I oversee all of the non-investment functions in the firm. That was legal, finance, HR, IT, compliance. And so the only thing we didn't outsource was the investment function. So we hired Proskauer as counsel. We hired PwC, another big brand name, to help us with audit and tax. We hired a boutique fund administrator, and they're still with us to this day as well. It's a group called Ultimus Leverpoint, and they're a really good fit for us. And then we hired an IT administrator to help us. That becomes more important than ever now as we grow, and there are cyber attacks on our business and our portfolio companies every day. We hired a PEO to help us manage benefits, administration, HR, et cetera. So we went with the outsource model, and it's worked well for us.
And what about the team? What did that look like when you first started, and how has that evolved to today?
Early on, there were 8 of us, and we had a lot of big dreams and hopes, but it was hard work. So we started with 3 full-time deal partners and myself to run the business stuff. We then realized we needed to build out a team. And so we hired one mid-level investment person who was a previous Charlesbank guy who was well known. And then we hired 2 associates. Finding 2 associates off cycle to join was probably the hardest thing we did then. We hire our associates exclusively out of the big management consulting firms, Bain, McKinsey, BCG, Parthenon, et cetera. So it was off cycle for them. We hired 2. One of those first day hires is now with us as a VP. After leaving us to go to Stanford Business School, he came back and he's with us now, which is great. And then we had our investment team rounded out, and then it was me. And then probably the best hire I ever made in my career was someone who's now our VP of operations here, 7+ years later, a guy named Sean Jordan. Sean came in as the ultimate Swiss Army knife. We need someone to get our IT world set up. We need someone to help manage the compliance program. We need someone to figure out how to order new printer ink. He did everything. And the promise at the time was, you're going to work hard. You're going to have an opportunity to have a real impact. And if you do well, you will grow with the firm and you will get well rewarded for it. And here we are 7.5 years later, and you have someone who is in the carry pool, who's a vice president, who now has a really big mandate at the firm. And that was our team, full-time in Boston folks. And then John was very prescient in realizing, if we're going to buy good companies and make them better, we need some operating talent who's actually run businesses around the table. And so we hired 2, what we call executive partners. They were former Charlesbank-backed CEOs who were retired from being CEOs of companies, but wanted to stay involved in helping grow companies. And they came on board for us in an executive partner role. And then we later added a third. 2 of the 3 joined at day 1 as well. And that was our team at the beginning.
Is that a different model where having those advisors from day 1 versus evolving into it and then hiring somebody to parachute in to solve a problem?
Yes, I think it is different. And this was part of John's brilliance, I think, from day 1. What a lot of private equity firms and venture capital firms will do is on day 1, they'll hire senior advisors or operating partners. They get put on the website. They have great backgrounds, et cetera. But they're really like akin to having a great library with a bunch of books on the shelf. And you only use them when you need a reference check on something. You pull a book off the shelf, you get some help with something, and then you put the book back on the shelf. That's not to disrespect senior advisors or operating partners at any other firms, because it varies tremendously. But we wanted a different role. So it's a hybrid between a senior advisor and an executive operating partner. They're more hands-on. So our executive partners are members of the GP. They have carry in the funds. They sit on the investment committee. They have a vote on the investment committee. They sit on our boards, and they're intimately involved in the operating aspects of our businesses because they have the experience that we don't have as private equity professionals.
I want to go back to the hiring and development and just talking about the importance of balancing that expertise. So you might have some generalist experts when you first started, but then trying to get that fit and work ethic. How do you balance those things in finding the right person?
It's really hard. There is trial and error involved, of course. And I would say we were very fortunate early on that we had very little error. in terms of the people that we hired. And the construct that we looked at it through was, do we hire experience or do you hire skill? Ideally, you like to have both. But in a startup environment where you're going to ask people to do a lot of different things, it's really hard to index for someone who can do a lot of different things and do them well. So we prioritized skill over experience and cultural fit over experience. Now, we weren't going to go and hire a marketing person to be our CFO. You have to have CFO skills to do that. But for a lot of those Swiss Army knife jobs, we wanted to find people that were going to work hard, we're going to think like owners, who are going to act like leaders on day one. Because we say around here all the time, there's no room for anyone to be a passenger on the bus. You are driving your own bus every single day. You get good people with a lot of energy, with values, who think like owners, who aren't afraid to make decisions. And then you let them go and trust them. You got to let them make mistakes, and then you got to really celebrate some wins. And so the promise early on to people was work hard. You're going to have a major, and then you're going to have a bunch of minors. Some people don't want to do that. And some people think that that's really cool. There's a growth mindset. I have an opportunity to learn every day, and it's going to be hard, but I'm going to grind through it.
Any advice you have for people? Because there's a lot of people who will come at you, they want to be in that role, but they may not be the right fit for the organization because maybe where they're coming from an organization that's on fire, they're running out of something and not into it. Is there anything that you tell people to keep an eye out for? How do you increase the opportunity to actually, nobody bats 1,000, but how do you actually hit 406?
Yeah, Ted Williams. I love Teddy Ballgame. We do all the traditional things. Okay, we filter resumes. We all interview people. We have interview methodology that we go through, but that's art more than science. But one of the things we borrowed from our previous life at Charlesbank was we give every single person an assessment, and it's like a Myers-Briggs type assessment. Early on, it was more of something we did at the end of a process when we thought we wanted to hire someone. We had them take the assessment anyway, just to see what it would say. Well, the first 3 or 4 people we hired, the assessment was like a look into their soul. And it was so eerily accurate. We started using it for every single hire and every process that we went through. And really what it got at was temperament, ability to be a good team player, ability to handle difficulties, the ability to handle a lot of things with a lot of uncertainty all at the same time. So this assessment process has become a big part of what we do with people in the interview phase. We take the assessment and when we turn it into a coaching document. So when someone joins us, that assessment gets turned into a coaching document, which is like a jumping off pad for how to manage that person's development going forward. So I would say traditional recruiting methods plus this assessment helped us find people who were going to fit what we were doing.
One of the other big questions I have is you hire somebody early on and they're a Swiss Army knife, but then as the firm grows, you have to grow alongside them as things get complex. How do you prepare team members for the future organizational complexity?
It's something we've been working on and it continues to evolve. But the promise to people early on is, okay, here's your major, here are your 3, 4, 5 minors. The sky is the limit for you on your growth potential. So just do a really good job with your major and your minors. And then as we grow, some of your minors will be given to other people. And so you'll narrow your scope a little bit. And at some point, you'll find a career out of this. So just trust. We'll invest in you. We'll give you opportunities to succeed along the way. But just trust that we're not going to be in hair on fire startup mode every day for the next 15 years. We've seen that play itself out over time. By example, we hired an operations associate a number of years ago, and she came in, and one of her minors was HR, talent, culture. Here we are a number of years later. That's become her major. She leads our effort around HR, talent, and culture, and she's a superstar for us. But that wasn't the promise on day one. The promise on day one was just find ways to add value, be a good teammate, and then as we grow, we'll try to find where your skills and desires and the firm's needs best match, and then we'll create a career for you. Now she has a career. Everybody has a chance to lead.
It's a great transition point to talk about culture, and would love to hear about how you continue to build culture for durability.
It's probably the thing we're the most proud of at Nonantum is the culture that we've established and then built over the last 8 years. You've heard the great Peter Drucker's comments about culture eats strategy for breakfast. When we launched 8 years ago, we spent a lot of time talking about culture. We could all go read 1 million books on culture, but what we defined it as is what you do is who you are. So what do I mean by that? How do you treat people? How do you act on a day-to-day basis? The best way to get a touch point on your culture is ask someone 30 days into their job what they think your culture is. And they will tell you what you've been doing for the last 30 days. And that will be your culture. We spent a lot of time early on from our shared experiences talking about what we wanted to build. And we also talked a lot about what we didn't want to build. We put some documents in place. We thought about these things a lot. Then you activate the culture. We wanted our culture to be one of humility, of respect, of hard work. John Biotti talks a lot about intellectual integrity and getting to the truth. And the best way to get to the truth is to have a culture of debate. But people aren't going to debate if they don't feel safe doing it. So building a culture where every single person, from your first day analyst to your senior partners, can sit at a table and have an argument, but do it in a respectful way, is at the core of the culture we wanted to build. And so here we are almost 8 years later, that gets reinforced every day. And along the way, some of the things we did to establish and then reinforce the culture were, we have an employee offsite every year. Prior to the offsite, we have a feedback survey that gets filled out by everybody. The feedback survey is pretty intense. It asks a lot of hard questions. We continue to refine it over the years, but we get the survey back. And when we go to the offsite, we share the raw results of the survey with our people. We don't just spit shine it and put up 10 slides that tell everyone in the audience how great we are. We give the raw results. And then we take the constructive feedback from those results and we put action plans in place for all of them. And then we check in the following year to say, here were the things we needed to work on last year. What did we do this year? And there's a readout of it. So we hold ourselves accountable. So I think that culturally, are we getting to the truth? Are we arguing? Are we doing it in a respectful way? Is every voice represented? That's at the core of what we've tried to build into the culture.
Talking about what culture you want to have, what were the attributes you were wary of in the industry that you wanted to avoid that may be common potholes?
We wanted people to show up with a voice, and we wanted to have really constructive debate early on. So avoiding the sweatshop and avoiding the command and control mentality to create a team environment. And we did that in a lot of ways, one of which was John comes from an Italian background. Food and meals with the family are the center of that culture that he grew up in. So we implemented that at Nonantum. We put a old school cafe table in our cafe. It's like a picnic table. And every day we bring in lunch for the entire team. People gather around that table and share a meal. And we don't talk about business. We might talk about what's your favorite podcast. You're probably going to make the list pretty soon. What are you streaming? Where did you go this weekend? Junior people, senior people, everybody gets involved in talking about life. And then when you're in the heat of battle, people feel a lot more comfortable expressing themselves. Every single person in the firm participates in our investment committee meetings every week. That's been a big part of the culture because you want people to act like owners and think like owners. If they don't know what's going on in the investment portfolios, they're not going to have as much attachment to the firm's mission. So we want everybody involved. So that's something we've been doing. And we've also put performance development plans in place. We do have a lot of fun. We have a morale fund. So our teams, they go skiing, they go on bar crawls, they go learn to take a cooking class. They do a lot of things together, and we've allocated funds to do that. We have a women's initiative where we bring in very prominent females from various parts of the industry to have private conversations with all the women on our team. And that's been a huge part of getting buy-in and building culture. And there's not a day that I don't walk through this office and hear a belly laugh somewhere, even on the worst of days.
Good stuff. There's a lot of great takeaways here. And Scott, I want to turn to close here with two questions. And first is, what advice would you give to an emerging manager from an operational perspective?
Wow, that's a good one. I would say plan to succeed. Plan for scale early on. Get ahead of your projected growth. Ask yourself, what do we want to look like when we get to Fund 3? And then backward map from there. Otherwise, you'll be changing the tire on the car while you're driving 85 miles an hour down the highway, and you will curse yourself for not doing some of these things earlier. That's hard to do, but we did a lot of that early on too. But build for scale early on, plan for success early on. You won't regret it.
And then the other question I have is, what one book, article, other reference material that you commonly refer to people?
I love to read. I love a lot of outside resources, but I would say the best industry resource that I would commonly refer people to is peers. I would say join some affinity groups, build your own informal board of advisors, and leverage them for anything and everything. You know, I filtered my list down to about 4 or 5 people when we started Nonantum, and they've saved me hundreds of thousands of dollars in advisory fees over the years. It just costs an occasional coffee or lunch. So looking at people who were in funds that were 3, 4, 5 years ahead of us, who had been down the road that we were about to go down, establishing your own little informal board of advisors like that to lean on was invaluable. So build and establish and cultivate a list of peers. It will serve you extremely well.
Scott, this has been a great conversation. A lot of takeaways on how to launch a fund.
It's been a lot of fun, Scott. I appreciate it. I appreciate what you're doing for our industry, paying it forward and paying it back. And I'm happy to be a small part of it. And good luck with everything along the way. Go Bruins.
Thanks so much.
Thanks for listening to the show. If you like what you heard, hop on our website at capitalallocators.com, where you can access past shows, join our mailing list, and sign up for premium content. Have a good one, and see you next time.